Hi, and welcome to the May update for the Valor Private Wealth client portfolios and what's happening with the AI transition. So, a lot's been happening over the last couple of months in the global economy. Obviously, there's been the Iran situation has been front of people's minds and in the news. Petrol prices are going up, interest rates are going up due to inflationary pressures. As we have discussed in previous newsletters, we think that the largest part of the economic transition over the next couple of years will be the AI and robotics implementation in the economy, and we're going to talk about that today. So just a bit of a general advice warning there. Please ensure that this is general advice only. If you do require any personalised advice, please give your advisor a call. So what's important is that, and as we discussed in our previous newsletter, is that this is not a normal economic transition where we have an extension of a human. Most other technology advances have been an extension to the human. And we believe that AI and robotics are a complete replacement of humans for many jobs. So not all jobs are at risk here in the near to medium term, but a significant number of jobs are potentially at risk. So AI has just surpassed human capabilities in many areas, and that's why we're constructing our portfolios for what comes next. So this chart's really important, and obviously this is just a graphical representation of what we think is happening. This is not exact numbers or science, but it really shows that up until recently, AI wasn't very good. The AI of 2024 was next to useless in a lot of roles. There's too much hallucinations. It wasn't doing a very good job. There was virtually no agentic AI. We'll talk about agentic AI in a second. But AI really it was really Opus 4.5, which is one of the best models was Anthropic. Opus 4.5 is now 4.7. That was released towards the end of last year, November last year, and that was a step change. And that was sort of the first time that that we got to see AI being better than most humans in many domains. And what we're projecting here is that AI capabilities continue to get better, and this is a very important point, is that we are not talking about AI getting to what's called AGI, which is artificial general intelligence, where the AI is smarter than all human beings in all fields. We're talking about just the AI getting much better than the median human being. And that's, I think, already happened in a lot of areas, and I think that's going to accelerate. But the key point is, from that chart there, the human capabilities are not advancing, whereas the AI capabilities are getting better every year. So for our thesis to be correct, our thesis just needs for the AI to continue to get better, which we think is a very, very high probability. And whilst robotics is not going to displace jobs at the same rate as AI displacing white-collar roles in the next couple of years, after AI started displacing jobs, the robots are only 2 to 5 years behind the AI. So our theory is that our thesis is that AI is significantly better than a lot of humans. Certainly next year, that starts to enormously replace human roles. But the robots are and robotics are a 2029 to 2033 story where they start to rapidly accelerate. So a great quote from Mo Gaudat, who used to be former chief business officer of Google X, is that this marks the first time in human history that humanity is no longer the smartest being on the planet, and that's really important. We're now the monkey to the human, and this is not a normal economic transition. This is a complete step change in who is the smartest beings on the planet, and that's why we're not treating this as a normal extension to the human transition, which is what a lot of technology transitions have been in the past. We think this is a complete step change where we have effectively an alien race coming down to Earth who's much smarter than us and is going to take our jobs, not enhance a lot of the roles. It certainly will enhance a lot of roles, but this is a much smarter being, if you want to call it that, coming down to Earth, and it's simply going to replace jobs. And this is the key slide here, which is can humans compete? The typical human in a good white collar role getting $100,000, including all the cost of that in terms of insurance, other parts of employing a human, so it's approximately $100,000 just for round numbers. So this is once again not exact, doesn't need to be exact. It's just illustrative of the difference between a $100,000 human and an AI being $5,000, which I think that a lot of the AI is going to get cheaper and cheaper. So it might even be $2,000 AI replacing a $100,000 human. Certainly at the more complex jobs, it might be a $10,000 AI replacing a $150,000 human. So there's a bit of a scale here, but this is just approximate numbers to show the difference that we have significantly cheaper workers, if you want to call it that, in terms of the AI, and we're moving from chatbot AI to agentic AI, where the agents can actually do jobs and complete tasks and work through full 8-hour days. We're getting up to about 5-hour days, but certainly 8-hour days is in the very near future. So this is a $5,000 worker AI versus a $100,000 human. We think it's quite stark who CFOs and CEOs are going to choose to employ. They'll employ the AI in a lot of roles. And once again, we're not talking about this happening in every single role. We're still talking about this happening in a much larger number of roles than a lot of economists have been discussing. So Dario Modi is the head of Anthropic, and Anthropic is probably the leading AI model producer in the world right now with their Claude Opus 4.7, and they have Mythos, which they've pre-released to some companies, which is supposedly much more powerful. He's not the only one warning. He's just the only one who's given a specific number. All of the heads of these AI labs are saying that they do think that unemployment could spike quite significantly. Dario's probably the one that's put the numbers on it in terms of, he said that we could get to 10 to 20% unemployment levels. Now, to put that in perspective, the GFC was 10% unemployment in the US. And if we get to 20% unemployment, this could be a double the GFC size event in terms of unemployment. And to put that in perspective, so in the last 100 years, the worst unemployment event was the Great Depression, which got to 24.9%. So these are not normal levels of unemployment predictions. Dario, whilst he has put a number on this, is not the only one warning about it, but we do think that the probability that there is significant unemployment is greater than what a lot of people are talking about. So what do we expect to happen? We've got a three-phase plan, which is a very specific plan on what we see happening, and we've got very specific triggers for seeing whether these phases are in stage 1, stage 2, or stage 3. So phase 1 is stagflation. That's just what's happening right now. We've got the Iran war pushing up petrol prices. We've got rising interest rates. We've got commodity price pressure, and the Aussie dollar is potentially going to rise in stage 1. So we think the stage 1 has potentially 6 to 12 months is the most likely scenario, maybe 18 months. The timing of this is not exactly perfect. No one can predict the timing, but we do think that stage 2, phase 2, when the AI jobs and robotics jobs, the early robotics jobs start to ease through the economy, it begins in earnest at some point in the next 6 to 12 months, most likely potentially 18 months. And that's when we start to see deflationary pressures, which is quite the opposite of the stagflationary pressures we have right now. Now, stagflation is rising prices, deflation is falling prices. And we think that if job losses start to increase a couple of percent, unemployment increases towards beginning to middle of next year, we'll start to see share markets going down. We'll start to see property markets going down. We'll start to see interest rates go down. Aussie dollar will likely go down, and falling interest rates. So that's phase 2. Phase 3 is the inflation phase, and we think that as AI continues to get better, and AI will very likely continue to get better, we think that this gap between human capabilities and AI capabilities will expand, and phase 2 deflation continues until the government steps in. and government and central banks. So that's when we start to see significantly more money printing than has happened than COVID and during the GFC, and that's when we start to likely see quite significant inflation from the governments, because they don't really have a choice. If we start to get to 10 to 20% unemployment, the governments must start printing money. So we think that phase 3 is really an inflation story, which is quite the opposite to phase 2. So we've built a three-phase investment plan for these three phases. So phase 1 is really getting out of the way. I mean, in stagflation, stock markets and property markets go down because of rising interest rates and rising pressures and less money in people's daily budgets. So if people have less money to spend, then generally speaking, we have less money flowing through the economy to property for shopping at David Jones and discretionary spending. So we have significantly reduced our exposure to consumer-facing businesses, financial-facing businesses, and things which rely on the general economy, because we think that stagflation is a net negative for economies over the next 6 to 12 months. The most important thing is that during all three phases, we expect to maintain our AI beneficiaries. So ASML is they write the lasers on the chips. TSMC is making the chips, and those two are near monopolies on the chips for AI chips. And then the cloud giants, which is Alphabet, Microsoft, and Amazon. So the picks and shovels of AI. We think they all do well. They'll certainly have some volatility over the coming years, but we think they'll do well over a 5 to 10 year period through all three phases. So phase 2, that's when we start to see job losses rise. We start to increase our Aussie gold companies. We'll buy some more US dollars. We'll increase Aussie exporters, and we'll potentially have some protection on our portfolios through using the currency. And so we look to buy more government bonds, longer duration government bonds, which means we have longer extended bonds. So instead of having a 5 or 10 year bond, we might buy a 20 to 30 year government bond, which they do well in a deflationary environment. And then phase 3, we need to get out of all our defensive assets as much as possible. Long-term government bonds, they do very poorly in stage 3. So a lot of the Aussie exporters don't do as well in stage 3 because we think that that's a complete reversal of stage 2. And we're looking at and tracking government stimulus measures and central bank stimulus measures from many angles, and stage 3, we want to buy inflation-protected assets. So the world's best companies, we want to buy floating rate notes if we do have any defensive assets, and we want to buy real assets like infrastructure, property, etc. So we're having a cautious approach, but we've got some asymmetric gains. So even though we are being quite cautious, and we are the most defensive we've been in 21 years for our clients, we do still think there's some things which actually have quite a bit of upside. So our gold miners, our grain companies, which we're about to buy, and blood companies, along with ASML, TSMC, and the hyperscalers, we actually think that there's still quite a bit of upside from these businesses, particularly in Australian dollars. So whilst we're being cautious, we still think there's upside in the portfolios in the next couple of years. The Aussie dollar, we think, is going to be quite. First of all, stage 1 is the stagflation. We actually think the Aussie dollar goes up in the short term. So please, if you see the Aussie dollar going up, please don't think that that's the end of our thesis. We think that's our expectation. There's the J curve of the adoption of AI means that there's stagflationary pressures because of the build out from the AI companies. But as we start into stage 2, we think the Aussie dollar materially declines and potentially pressures the lower bound area where it was in 2001, which is 47.7 cents. So with a falling Aussie dollar, there's ways to profit from that, and we're going to look to profit from that during stage 2. Stage 3, the Aussie dollar recovers. So we want to sort of take some profits on the Aussie dollar and then maybe look to hedge or to just get out of things which we think could have rising Aussie dollar. So 3 very distinct stages for the Aussie dollar. Temporarily rising, maybe up a couple of cents more to its highs, and then the deflation, significant falls, and then inflation reverting back to its longer term averages. So we're tracking this in real time. We have multiple trackers. We actually have 6 different trackers which we've built using AI. Some are tracking jobs, some are tracking official data, some are tracking greenfield job displacement. We're looking at announcements from AI, so to see if we're wrong. So if there's more job announcements from AI companies, then that's a good indicator we're wrong on this. And we're very happy to be intellectually honest and say, okay, we're wrong. Let's change tact here. But so far, all the trackers are confirming our thesis, but saying we're a little bit early, which is exactly what we expect, which we think that this has got another 6 to 12 months before we start to see significant job loss announcements. But one of the most important things is the markets are forward looking. So if the markets perceive that there's going to be quite a few job losses from AI and robotics, that's when the stock markets move, not when the job losses are announced in the rearview vision and unemployment. So unemployment might hit 6%, but the markets might have already started falling 6 to 12 months before the unemployment hits a number because the market is forward-looking. And that's why we are being conservative now, not waiting and trying to time the market 6 to 12 months from now. As I said, this is a fluid 3-phase plan. It's not a set and forget portfolio. We are using signals and being quite active because this is, as we said, one of the fastest and most important economic transitions in human history. So Demis Hassabis said that this is 10 times the size of the Industrial Revolution at 10 times the speed. So we are being very active in the portfolio, more active than usual, but this is a very unusual phase of over the next 2 to 5 years of economic transition. This is not a normal economic period. We think that this is potentially somewhere between, as Dario Modi said, somewhere between the GFC and the Great Depression. This is not a sit on your hands and do nothing environment. This is a monitor, be very active and make sure we don't lose permanent capital, which I think is a risk of a lot of the other people who are ignoring these signals. And quite importantly, we are intellectually honest that there is a scenario where we're wrong on this. But if we're wrong, there's most indications are that the stock markets are at or near the highest valuations they've ever been. So if we're wrong, we think that the upside from owning risk assets right now is as poor as it's been for a very long period of time, if not one of the worst times to own significant risk assets. If you look there, they've got a fantastic chart from D Short, and all credit to them at Advisor Perspective. So you can see there clearly that, and this is one way. This is 4 different ways of valuing the market. Nothing's perfect. There's no perfect market valuation indicator, but it shows there 1929, 1969 dot-com bubble, 2021 bubble, and the current bubble is above all those bubbles in terms of valuation markets. So categorically, we're in an expensive market. So whether we're at the absolute top or whether it goes up another 5, 10, 15%, we're not trying to pick the tops at all. We're trying to say, okay, right, where are we in the cycle? And we're far closer to the top of the cycle than the bottom. This is not March 2009. That's one thing I can assure you. So if it was March 2009 and we had very low valuations, maybe we've got a margin of safety to own more risk assets. But this is not March 2009. This is one of the most expensive times in history to be in risk assets. Jack Bogle has a formula, and his formula was the dividend yield of the market plus the expected earnings growth, which is approximately 5%, plus reversion to the mean for valuations. And we use his formula. Right now, that formula is suggesting 3 point something, maybe 4% returns. So that's not a reason when you can get 5% or so on a government bond and you're only getting 3 point something percent on stocks in the next decade. The government bonds are starting to look quite attractive. So, and another good example of where valuations really stand is what Warren Buffett's company, which is now sort of stepped back, and Greg Abel's doing a fantastic job. But the amount of cash that Berkshire Hathaway is sitting on, and that's actually risen since only last weekend. I haven't updated these numbers, but it's actually risen since then. Berkshire Hathaway is sitting on record levels of cash because the valuations are not attractive. So that's a hint of what most people should be doing, but yet most people are getting quite excited about markets, which is, as Warren said, how to become wealthy. close the doors, which is you're saying ignore everyone else. Be fearful when others are greedy, and greedy when others are fearful. Be fearful when others are greedy, and greedy when others are fearful. The greed in markets right now is as high as we've seen it for a very long period of time, if not ever. Therefore, you should be somewhat, if not quite, fearful of market levels right now, and our caution will be likely warranted, regardless if we're right on AI or not. So I think that our positioning is a good level of positioning for not only AI job loss and robotics job loss risk, but also for just simple valuations and not reflective of significant returns over the next decade. Thank you very much for listening, and I hope you've learned something. Once again, please give us a call. We'd love to have a chat if you have any questions of this. And thanks again.